Welcome, and thank you for taking the time to listen to our presentation. I'm John Chrisman, CEO and President of Apache Corporation. With me today are Steve Riney, Executive Vice President and Chief Financial Officer, and Tim Sullivan, Executive Vice President of Operations Support. With this presentation, we are providing the most current context related to Apache's outlook for 2017 and 2018, as well as a detailed review of the steady progress we are making at Alpine High. I won't review our notice to investor statement. I expect you're familiar with it and encourage you to review it if you're not. We will begin today with a brief corporate overview, reiterating the management objectives we have operated under since early 2015 and outlining how those objectives still underpin our 2017 and 2018 plans. We will then provide a brief update on our region highlights, followed by a review of our revised third quarter and fourth quarter 2017 production guidance, which reflects a few operational impacts and timing delays, mostly related to Hurricane Harvey. This will be followed by an in-depth review of our progress at Alpine High, which is substantial. We will review the geology of the play and share our understanding of the critical play parameters that have influenced our activities during the evaluation phases. For competitive reasons, some of these parameters have not been previously discussed. Next, we will describe Alpine High as we see it today, in terms of three distinct plays: an extensive and highly economic wet gas play, a very economic dry gas play on a portion of our acreage, and an attractive emerging oil play in the Wolfcamp and Bone Springs. We will provide updated performance results from some of our previously disclosed wells and some new drilling results, along with an updated view of development economics, which are very compelling at current commodity prices. Lastly, we will outline the progress we have made on our infrastructure build-out and our hydrocarbon marketing strategy. There is a lot to cover, so let's get started. Over the past several years, we have been on a journey to transform Apache. We have streamlined the portfolio, refocused the capital allocation process from volume growth to returns and value, and strategically transitioned the company from acquire and exploit to returns-focused organic growth. Our vision for Apache is to be the premier exploration and production company with global assets focused on North American growth. We are very pleased with the progress we have made to date and with the opportunities we have created for the years ahead. A number of investment highlights are contributing to Apache's outlook for long-term profitable growth. We have a strategically diversified portfolio that features strong free cash flow generating assets in Egypt and the North Sea, which benefit from premium Brent crude oil pricing. These cash flows feed a top-tier position in the Permian Basin that is our foundation for long-term growth. With this portfolio, Apache can deliver highly competitive per-share growth rates funded primarily by internally generated cash. We believe that over the long term, growth should be funded through operating cash flows. However, there are times when outspending operating cash flows is compelling. The startup of Alpine High was a strategic milestone for Apache. Thus, we funded it with the sale of $1.2 billion of non-core assets this year. I will go into more detail on this on the next slide. We are rigorously focused on long-term corporate-level returns. We implemented a comprehensive capital allocation process in 2015 with investment decisions made across the entire portfolio based on fully burdened economics. We believe capital allocation based on well-level, half-cycle economics are short-sighted and fundamentally flawed for building long-term shareholder value. Our fundamental approach to the business focuses on cost management, long-term full-cycle returns, and living within cash flow. It is gratifying to hear many others in our industry beginning to follow on this same path. Concurrent with a more disciplined fiscal approach, we also shifted our strategy to returns-focused organic growth, which led to our Alpine High discovery. Through all of this, we have not diluted our shareholders, nor cut the dividend to follow the herd in a pursuit of growth at questionable value. Instead, we have maintained a strong balance sheet and we have avoided high-cost acreage acquisitions. We will continue with the same disciplined approach. So let's take a quick look at how our management philosophy has impacted both our 2017 plan and our past and current views to 2018. In February of this year, we set our 2017 plan based on $50 WTI, among the most conservative in our peer group. Our $3.1 billion capital program included over $1 billion of planned outspend, $500 million to continue the build-out of Alpine High infrastructure, and $600 million outspend in the upstream. This level of outspend was a temporary departure from our general belief that the upstream should be capable of growing within cash flows, but it was necessary to complete delineation and commence development of the Alpine High. This drilling program was strategically important, despite infrastructure not coming available until mid-year. Even then, we knew it would require more time to line out facilities, hook up wells, and to allow those wells to flow unconstrained. Thus, operating cash flows, as in the early stages of any large project, will be trailing capital investment for a significant period of time. We have taken two material actions to fund the capital outspend in 2017. First, we weren't convinced of the underlying strength in oil prices at the beginning of this year, so we underpinned the funding for the capital program with $50 puts on our second half oil production. Second, we have sold $1.2 billion of non-core assets year to date. When we established our 2017 plan, we also announced a plan for 2018 that was based on $55 WTI. That plan reflected a similar capital program of $3.1 billion, representing approximately $500 million of outspend, all on Alpine High infrastructure. Upstream investment under this plan was projected to be cash flow neutral in 2018. We are currently updating our 2018 plan, which will incorporate our latest views on production volumes, industry inflation, continued operating efficiencies, and possibly a lower oil price assumption. As a reminder, a $5 movement in oil prices impacts our annual cash flows by approximately $350 to $400 million. In 2018, we have a number of levers that we can pull to offset any outspend. These could include changes in planned activity levels, ongoing operational efficiency improvements, continued non-core asset sales, and an Alpine High infrastructure monetization. We also plan to end 2017 with approximately $1.7 billion of cash, so we will have plenty of liquidity going into 2018. At the end of 2018, we will have spent over $1 billion on our Alpine High infrastructure. We are confident that this is both a high-value investment and strategically important during the early phases of the Alpine High development. As we have indicated in the past, we do not need to fully own and control these assets for the long term. We are preparing to commence some form of a monetization process in the 2018/2019 timeframe. Now I'll move to a brief overview of our operations before turning to guidance and the Alpine High review. Around mid-year, we returned to a growth trajectory in the Permian Basin, with oil production in particular now delivering at the high end of our expectations. Production from our lower 48 operations outside the Permian has stabilized, as declines have shallowed and we continue with a limited drilling program to hold acreage. Our international regions are benefiting from the recent strength in Brent-linked crude prices. In the North Sea, we have 2 wells producing at Callater, with a third offset well expected to commence production later this quarter. These wells are highly productive and are currently constrained due to facilities capacity. The current oil cut at Callater is approximately 70%. In Egypt, we received final award of our 2 new concessions, totaling 1.6 million net acres. We see tremendous oil potential on this new acreage and will commence drilling there this quarter. At the end of September, we began shooting high-resolution 3D seismic in the West Kalopsha concession. We will ultimately expand this shoot to cover the majority of our acreage. This is the first seismic survey of its kind in the Western Desert. Excluding partial year volumes for Canada, Apache's third quarter production will be higher than the second quarter, and we expect fourth quarter volumes will be higher than the third quarter. Apache will end 2017 with increasing production, lower debt, and more cash on the balance sheet than we had at mid-year. We are now building strong momentum that we look forward to carrying into 2018. Next, I will provide you with a production guidance update which reflects the impacts of Hurricane Harvey. We anticipated the potential operational impacts ahead of the storm. We planned accordingly with our production and marketing teams working closely together to minimize the impact of force majeure notices. We built diesel fuel inventories, arranged alternative transportation and storage, and took other proactive steps to keep our operations running. Consequently, we avoided material shut-ins or flaring events and thus experienced only minor disruptions in production. Our teams did a great job. We also experienced second-order impacts that are a bit more meaningful. Impaired capacities at third-party operated midstream and downstream facilities temporarily constrained our production capability. More significantly, at Alpine High, our infrastructure build-out has been delayed, in particular for two central processing facilities. The startup of our Hidalgo facility in the southern portion of the play has been pushed from the third quarter of 2017 to late fourth quarter 2017, and the Cypress facility in the northern part of the play has been pushed from fourth quarter 2017 to first quarter 2018. Both delays are a result of Harvey-related damage to Houston area manufacturing facilities that are providing key infrastructure equipment. These issues are being rectified, and we do not expect any prolonged impacts on production volumes. To reflect these impacts, we are updating our third and fourth quarter production guidance. As shown, we now expect our North American production volumes to be in the range of 206 to 208,000 barrels of oil equivalent per day for the third quarter and 218 to 224,000 barrels of oil equivalent per day for the fourth quarter. The vast majority of these volume reductions consist of deferral of natural gas. Our Permian production bottomed in the second quarter of 2017 and has returned to a very nice quarterly growth track, which is attributable to both our Alpine High ramp and strong performance in the Midland Basin. While Hurricane Harvey will have some timing impact on our gas volumes as we just discussed, our oil volumes in the Permian are performing very well. We are currently projecting to be at the high end of our fourth quarter 2017 Midland Delaware oil production guidance provided back in February. The southern Midland Basin has been a big driver of this performance, as we recently brought online 2 pads at Wildfire, which is one of our core fields in the area. Both pads were drilled with 1.5-mile laterals and had average per well drilling and completion costs of $6.5 million. The June Tippett 1213 pad consists of 7 wells, 4 in the Lower Sprayberry Shale on 440-foot spacing, and 3 in the Wolfcamp B interval on 880-foot spacing. Average per well performance from this pad has yielded a peak 30-day average IP of 1,046 BOEs per day, 2-month average cumulative production of 47,000 BOEs per well, and current production is still averaging just under 1,000 BOEs per day per well, with an 85% oil cut. The Lynch A unit pad is a 6-well pad in the Lower Sprayberry Shale, also with 440-foot spacing. This pad has been producing approximately 40 days, with an average cumulative production of 35,000 BOEs per well. These wells are currently producing at an average rate per well of 1,200 BOEs per day with an 89% oil cut, and they are still cleaning up and getting stronger. These excellent results are reflective of our integrated approach to determine optimal landing zones, pattern spacing, and completion design. Prior to year-end, we anticipate bringing online 3 more pads in the Southern Midland Basin, which consist of 20 total wells. The 3 pads will be located in the Powell Field and will contain a combination of 1.5-mile and 2-mile long laterals. On the international side, we are revising our production guidance to reflect the following. In the North Sea, third quarter volumes were impacted by longer than expected turnaround activities, while the fourth quarter outlook has been reduced to reflect the impact of a recent dry hole. In Egypt, we expect that third and fourth quarter net production volumes will be lower due to the recent improvements in Brent index crude prices and its impact on cost recovery volumes. Our revised third quarter guidance is now 146 to 148,000 BOEs per day, and our fourth quarter guidance is now 150 to 156,000 BOEs per day. Projected cash flow from our international regions remains robust, as a recent relative strength in Brent-linked crude pricing more than offsets the production impacts shown here. Let's now move on to the Alpine High update. I will first outline where we were approximately a year ago when we announced Alpine High. Then I will review the progress we have made over the last year, including many learnings and insights we have not previously shared. We have come a long way in 1 year, and Alpine High is getting better. We will take you through how we see the play today, and will do so in quite a bit of detail. We have an extremely large wet gas play with over 3,500 highly economic locations. As we transition this play into development mode based on 4,400-foot laterals, we see well costs of $4 to $6 million, with NPVs ranging from $5 to $8 million for a typical well and an NPV of up to $19 million for a high-end well. The economics of this play are driven by the low cost and the tremendous volumes of oil and NGLs. Longer laterals provide additional upside to the play's economics. We also have a dry gas play with over 1,000 highly economic locations. These wells will cost around $5 to $6 million in development and will generate average NPVs of $3 to $7 million per well. And we have an emerging oil play in the parasequences. Just like in the rest of the Delaware Basin, the Wolfcamp and Bone Springs take some time to map and test. Once understood, they too can become prolific producers and highly economic. Thus far, we have drilled 5 wells into the parasequences, with 2 being very productive, and one of which has been online long enough to be confident it will be highly economic. We still have much to learn in the parasequences, but we are confident we now have at least 500 locations, and we are equally confident there are more to come. Finally, we will discuss some of the key play parameters that make Alpine High successful. We discussed some of these last year when we introduced the play, but there were a few we did not discuss due to competitive sensitivities. Today we will go into more details on things like seal integrity and deeper geologic complexities that were key to making the discovery. When I presented the Alpine High last year, I said we were looking for the next big resource play. The most likely place to find this would be in the greatest source rock in North America, which is commonly recognized as the Woodford and the Barnett. We began that search with a map that looked something like this. The early foundation for today's Permian Basin was deposited in a broad marine setting now known as the ancestral Toboso Basin, and later transformed during Permian time into the Midland and Delaware Basins and the Central Basin Platform. The Alpine High, in the present-day Delaware Basin, is a geologic age equivalent of the Arkoma Woodford and Scoop Stack plays. As I indicated last year, Apache held a very different view of the prospectivity of this area. We believe the Alpine High held significant potential for both wet gas and oil. The common belief was that this area had been buried deep with the rest of the Toboso Basin, subjected to temperature and pressure extremes, and later uplifted with the same activity that formed the present-day Central Basin Platform and Davis Mountains. Apache believed the Alpine High was always a paleo high, and with some relatively minor uplift, remained in the maturity window that would generate wet gas and oil. It possesses a very thick, continuous transgressive source rock interval that spanned from Woodford to Pennsylvania in time. It has high organic content, very low clay content, and is very conducive to hydraulic fracturing. Additionally, there is a thick overlying parasequence interval that contains both the Wolfcamp and Bone Springs formations, which is also highly prospective for wet gas and oil. After drilling several concept test wells and 9 producing wells, we presented Alpine High on September 7th of last year. At that time, we had assembled a 307,000 net acre position, which represented approximately 20% of Reeves County. While others were pursuing more sought-after acreage packages and paying up to $50,000 per acre, Apache leased the Alpine High at an average cost of $1,300 per acre, which will greatly enhance long-term returns. The Alpine High is truly unique. It contains an unprecedented vertical hydrocarbon column of 4,000 to 5,000 plus feet, with 5 discrete hydrocarbon-bearing formations, the Woodford, Barnett, Penn, Wolfcamp, and Bone Springs, each with multiple target zones. At that time, our testing was focused on the Woodford and Barnett formations, where we estimated hydrocarbons in place of 75 trillion cubic feet of rich natural gas and 3 billion barrels of oil. We assigned 2,000 to 3,000 future drilling locations in just these 2 formations. So let me now transition to what we have accomplished and learned over the last year. We have now drilled over 70 total wells at Alpine High, including many necessary concept test wells that were drilled to verify our understanding of the play. This has enabled us to geographically and stratigraphically delineate the play and confidently high-grade our acreage position. We have also made great progress in the initial phases of the infrastructure build-out. Before we go into more detail on these topics, let me first say something about the status of the competitive activity. 1 year ago, there was little activity in the vicinity of Alpine High outside of Apache. What a difference a year makes, as shown on the right-hand side. Much of this is the result of the movement of the northern Delaware Wolfcamp and Bone Springs activity into the southern Delaware Basin. We view this as validation of our belief that the Wolfcamp and Bone Springs are prospective in this area. Some of this activity, though, is directly attributable to the Alpine High discovery. We have experienced competitive bidding for acreage positions, and we see permit and drilling activity that can only be in pursuit of Alpine High analogs. We also see Alpine High presentation materials appearing on competitor websites. As a result, we have been very cautious with the data we have chosen to disclose publicly. While we have advanced our position to a point where we can now be more forthcoming with some disclosures, we will continue to be cautious with certain aspects of Alpine High that we believe to be competitively sensitive. Now let me turn to the geology of the Alpine High. Alpine High is an anomaly in the region. Despite the significant tectonic movement all around it during Permian time, a 450,000-acre area remained relatively intact despite the subsidence of several thousand feet of its eastern limb and a later upward thrust of the Davis Mountains to the southwest. The Alpine High remained a relatively stable paleo-high through time. Through all that movement, the Alpine High maintained its basic structure and can now be generally represented as having a crest with both a northern and southern flank. The northern flank encompasses approximately 56% of Alpine High acreage, where we have drilled 54% of our wells to date. This concentration of drilling activity does not suggest that we believe this acreage is better quality or more prospective. Rather, we have directed most of our delineation and testing activities into the northern flank because the area contains many of our initial leases, which have the nearer term expirations. This is also where we initiated our infrastructure build-out to support the drilling to hold the acreage. Apache initiated its parasequence oil testing program in the northern flank, where we have drilled 5 wells to the Wolfcamp/Bone Springs to date. The crest encompasses approximately 16% of Alpine High acreage, where we have drilled 32% of our wells to date. We prioritized our delineation in the crest area to verify the productivity of the transgressive source interval, which is a key for scaling the infrastructure build-out. We generally have ample time on these lease terms, which allows proper mapping and testing of the Wolfcamp and Bone Springs. The southern flank encompasses approximately 28% of Alpine High acreage, where we have drilled 14% of our wells to date. This area is characterized by larger leases with generally more time on the primary term. While this area contains the fewest wells, drilling on the Hidalgo pad has confirmed that the transgressive source interval is overpressured and productive on the far southern end of the Alpine High. Competitive drilling activity just off the Alpine High in this area has confirmed oil production in the Wolfcamp Bone Springs, and Apache is currently mapping these formations on its acreage. This slide provides a new view of the structural cross-section at Alpine High, which we have divided into the aforementioned geologic settings of northern flank, crest, and southern flank. You will note we have expanded the vertical scale to highlight the geologic features of Alpine High. The horizontal axis covers approximately 60 miles, while the vertical axis covers 6,000 feet. The color shading depicts the transition from oil-generating temperatures and pressures in the shallowest zones, depicted by the green shading, to dry gas-generating temperatures and pressures in the deepest zones, depicted by the red shading. The orange shading in between depicts the temperature and pressure zones that generate what we refer to as wet gas. The very fact that the Alpine High can be depicted this way proves we are dealing with a true unconventional play. For the most part, the hydrocarbons are not migrated. Otherwise, you would have dry gas on the top and heavier oil on the bottom. Equally important in this depiction is noting the depth of the source interval. This is the Woodford, the Barnett, and the Pennsylvanian interval, which ranges from 1,100 to 1,600 feet thick and rises and falls throughout the Alpine High. Note that we have placed several control points that we have drilled on the cross-section. Red dots denote dry gas wells, orange dots denote wet gas wells, and green dots denote oil wells. Every well has validated the thermal maturity model. Next, I'd like to contrast the maturity windows in each of the three areas. In the northern flank, you see that the source interval ranges from wet gas down to dry gas in the deepest section. You will see several dry gas wells drilled in this area as acreage retention requires drilling to the Woodford. As you will see later, these wells have robust economics. As a result of the depth of the source interval, this area possesses the thickest section prospective for the Wolfcamp and Bone Springs parasequences. The northern flank in particular is significantly overpressured. The crest provides about 10 miles of continuity between the northern and southern flanks. The transgressive source rock is predominantly in the wet gas window and moderately overpressured. Portions of the crest also have potential for the source rock in the oil window. There is also upside in the parasequences in the oil and wet gas windows. In the southern flank, the source interval lies predominantly in the wet gas and oil windows and is overpressured. As we have noted, both the transgressive source rock interval and the shallower parasequences are very thick at Alpine High. The source rock, which comprises the Woodford, the Barnett, and the Pennsylvanian, is a very consistent, predictable, and contiguous deposition like that seen in most other true resource plays. There is very little in situ water as the rock is saturated with hydrocarbons. As previously demonstrated, the source interval encounters all three hydrocarbon phases, oil, wet gas, and dry gas, at various points across the play. The Permian transgressive parasequences encountered within the Delaware Basin can be characterized by a high degree of variability, both vertically and laterally. This makes it more challenging to assess the location and effectiveness of confining boundaries occurring within this water-wet petroleum system. Apache has drilled 5 wells within the northern flank setting to evaluate the source, reservoir, and mechanical properties of this more complex section. which includes portions of the Wolfcamp and Bone Springs formations. The objective is to conduct a comprehensive analysis of these prospective intervals integrating core, PVT, subsurface, mechanical stratigraphy, and petrophysical parameters within multiple 3D seismic attribute and inversion volumes. These efforts will enable the most expedient and value-oriented development of the parasequences at Alpine High. The stacked pay potential at Alpine High can be seen on the logs of two wells. These were drilled 20 miles apart, and there is obvious continuity for both the transgressive source interval on the bottom and the parasequence interval on the top. If we take actual drilling results from three specific areas, we can demonstrate how the source rock interval depth works with the thermal maturity model. For example, at the Redwood unit, the source interval is buried deep and is in the dry gas window. At the Weissmies unit, the source interval is elevated to the top of the wet gas window. Down to the south in the Hidalgo unit, the source interval is buried deeper again, but in the southern flank, there is a thermal gradient change relative to the northern flank and crest, such that we encounter cooler temperatures at any given depth. For that reason, the oil window and the wet gas window will be encountered at deeper depths. The Hidalgo wells delivered hydrocarbon content similar to the Weissmies wells, even though they are closer in depth to the Redwood wells. As actual well data from these three areas demonstrate, the thermal maturity model is very predictable. Coming up the hydrocarbon column results in less gas, more oil, higher BTU gas, and lower API gravity oil. Now, looking at the shallower parasequences, we see the same thermal maturity model at work, with lower gravity oil and higher BTU gas as you move up the column. Note the API oil gravities at these three units range from 41 degrees to 45 degrees, putting the Wolfcamp and Bone Springs squarely in the oil window. When we revealed Alpine High last year, we explained the structural history, thermal maturity, and reservoir quality as key risk parameters of the play. What we also understood, but chose not to share due to competitive reasons, was the fact that the seal integrity of the source rock, the impact of deep-seated faults, and shallow geologic complexities were also key parameters that must be understood to be successful. A proprietary 3D seismic survey over the entire area was required in conjunction with several vertical concept test wells to collect core, PVT, and fluid data and other key information. This enabled us to confirm and refine our understanding of the critical parameters of the play and to delineate the prospective fairways. Our identification of these risks dictated our approach to the play, and our drilling and testing programs over the last year were designed to allow us to assess the performance of wells in close proximity to some of these complexities. A lack of understanding of these key factors explains why many other operators failed prior to Apache. It is important to note that we have always conservatively risked our location count to account for these factors and will continue to do so in the future. To date, we have 10 proven landing zones, which are present and prospective to different degrees across Alpine High. In the source interval, this comprises 3 in the Woodford, 2 in the Barnett, and 1 in the Penn. In the parasequences, this includes 3 identified landing zones in the Wolfcamp and 1 in the Third Bone Springs. We see the potential of adding at least 3 more landing zones, 1 more in the Barnett, and at least 2 in the parasequence interval. We are confident there will be further upside across this unprecedented hydrocarbon column. Here we have characterized our 5,000-plus locations by formation. In the wet gas play, we have identified 3,500-plus locations in the Barnett and Woodford, with additional upside potential in the Pennsylvanian and the Wolfcamp. Our wet gas location count will likely also increase in the Barnett and Woodford with the addition of more landing zones and tighter spacing. In the dry gas play, the 1,000-plus locations are also located in the Woodford and Barnett, and only in the northern flank. There is potential, longer term, to add more locations in the Penn and through tighter spacing than the current 925-foot assumption. All 500 plus of our oil locations are currently associated with the Wolfcamp and Bone Springs formations. Further oil location upside exists as we map and test these formations across an expanded geographic area and identify further productive landing zones. Upside oil potential also resides in the Woodford, Barnett, and Pennsylvania source rock, where these formations are encountered in the shallower maturity windows. We are also working to continually high-grade our acreage position. Between our own extensive geologic and geophysical work and many other third-party studies involving the Alpine High area, we are focused on two different types of geologic complexities across the play. The first is deep-seated faults that may impact well performance and create potential seal integrity issues within the source rock interval, as well as potentially providing pathways for formation water from other zones. This type of complexity is represented in the seismic picture on the left from the southwestern portion of the play. As a result, this area carries a much higher risk profile for drilling economic wells. The other significant geologic complexity is the groundwater flows that form the many natural springs around Balmorhea. Water flows sourced primarily from the mountain ranges west of Alpine High generally run from the northwest along the Reeves County and Jeff Davis County border and rise to the surface in those springs. Based on information from both our own efforts and from numerous third-party studies, our understanding of the groundwater systems places portions of our acreage at risk to encounter these underground flows in a drilling program. While those risks are not insurmountable, they would make an extensive drilling program more complicated. These deep and/or shallow complexities exist in and around the area highlighted in gray on the map. As we look at these shallow complexities, in conjunction with our understanding of the deeper hydrocarbon prospectivity, we plan to minimize any drilling activity in this area. I would like to emphasize that our location counts at Alpine High have never included any wells in these areas. With all of the ongoing learnings, we have leased new acreage in areas identified as higher quality. We have also allowed some acreage to expire. This is consistent with a view that not all acreage is equally prospective, and we will continue to evaluate our position accordingly. We currently hold approximately 336,000 net mineral acres at Alpine High, an increase of 9% from September of last year. Based on the work I just discussed, we have concluded that a small portion of this net acreage is not currently prospective for drilling. Before I turn it over to Tim and Steve, I would like to note that it is relatively unprecedented for a single company to control a resource play the size of Alpine High in terms of combined vertical thickness and aerial extent. The science and learnings I just shared require a tremendous amount of time and hard work. At roughly 70 wells into the play, which will ultimately contain thousands of wells, we are very pleased with our progress and excited about the potential that lies ahead.
Thank you, John. There are many lenses through which we could look at the Alpine High. The structural lens of a crest with northern and southern flanks, which John just discussed. The stratigraphic lens with the Woodford at the base through the Bone Springs at the top. Today, however, I'm going to discuss the Alpine High in terms of three separate hydrocarbon plays. An extremely large and highly economic wet gas play, a smaller but also economically compelling dry gas play, and an emerging oil play. Although I won't discuss it in any detail today, we believe there will ultimately be multiple oil plays as we continue to test everything Alpine High has to offer. My comments will include updates on the performance of wells we have shared in the past, results from new wells drilled more recently, and a summary of development scenario economics for each of the plays. I'll conclude by noting some of our areas of focus going forward. I will be showing updated results from wells that we have previously announced, in addition to several new wells. In total, I will be showing production data on 24 of the 34 wells we currently have online, which we believe to be a representative population of results to date. In addition, we have 8 wells currently waiting for infrastructure. The wet gas play represents the largest portion of Alpine High and the majority of our current completions. The significant potential of the wet gas play is underpinning our investment infrastructure build-out. The wet gas play lies predominantly in the source interval, spans all three structural settings, and contains at least 3,500 well locations, assuming 800-foot spacing. We have a considerable amount of oil and condensate in the wet gas window, which I will highlight as I go through some of the well data. To date, we have seen oil mix in excess of 110 barrels per million cubic foot and BTU contents up to 1,500, yielding significant NGL volumes. The economics of the wet gas play, which I will summarize in a moment, are very compelling and highly competitive. So let's review the performance of several recent wells and update the production history of several wells we have previously disclosed. First, let's take a look at the gas rate performance and the potential range of gas-only EURs. Here are actual gas production plots for 15 of our wet gas wells. This is a log-log plot with production rate on the vertical axis versus cumulative production volumes on the horizontal axis. This format allows for easy production comparison of wells in light of extended shut-in periods and allows for easy interpolation to future ultimate recoveries. I have also plotted three hypothetical type curves with gas-only EURs of 5, 10, and 17 BCF. Most of our wells group nicely around the 10 BCF type curve, with a few approaching the higher end. Please note this plot contains wellhead wet gas volumes. Many of our wells have a significant amount of oil and condensate produced with the gas, and the high BTU gas yields additional volumes of NGLs through processing. When accounting for all the liquids, the ultimate recovery in gas equivalents for these wells can range from 1.2 to 1.8 times the wet gas EUR. Here are the details for all the wet gas wells plotted on the previous slide. They are ordered from top to bottom by increasing total vertical depth. With this view, you can easily see the strong correlation between depth and oil content, which is reflective of the thermal maturity model. Shallower wells have a higher oil content and higher BTU gas, regardless of producing formation. We have also listed peak 30-day IPs and cumulative production, which demonstrate impressive performance. These wells are reflective of our 3,500-plus wet gas locations that are primarily in the Barnett and Woodford and span the majority of our acreage position. Please note the wells highlighted in green have not previously been disclosed. This is a summary of wet gas well economics that we anticipate in development mode. These are fully burdened economics, which means we are calculating values and returns with allocations of all present and future costs, all the way up to corporate level overhead. We have subdivided our wet gas economics into ranges for a typical well and for an upper range well. The exact distribution of wells that fall into these categories is still to be determined, but here we have broadly characterized the mid-range of wells as the typical well and the upper quartile of wells as the upper range well. The key takeaway is the tremendous NPV generated. A typical well generates between $5 and $8 million of NPV, while an upper range well generates between $8 and $19 million of NPV. It is important to note that the endpoints shown for EUR, NPV, product mix, and well costs are ranges and may not correlate directly when read in a column. Also note that wells at the upper end of our oil and NGL ranges generate positive returns even at zero gas price. The weighted average typical Alpine High wet gas well is estimated to produce 13.3 BCFE of hydrocarbons, of which 6% is oil. The recoverable oil volume is 130,000 barrels per well and 455 million barrels of oil for the entire project based on 3,500 wet gas locations. This would yield a 13.4 recovery factor on the 3 billion barrels of stated original oil in place. Here we highlight the relative performance of our wells versus the wet gas zones of the Scoop Stack Play, which is a geologic analog. The Apache wells in this comparison are the same as those previously shown. The SCOOP/STACK dataset includes wells with first production dates starting on or after January 1, 2014. The P50 type curves for comparable wet gas SCOOP/STACK areas are shown on the rate versus cumulative production graph and are compared to the actual well performance to date from Alpine High. These Alpine High wells compare very favorably to the more optimized SCOOP/STACK wells, tracking predominantly in the top quartile or better. Of note, the SCOOP/STACK wells have an average lateral length 50% longer and cost 50% more than the Alpine High wells. The Alpine High production curves have not been normalized to account for these differences in lateral length. We believe the economics for the Alpine High wells will be much stronger than the SCOOP/STACK, as we can drill cheaper wells to achieve the same or better production volumes. We would also expect our well performance to further improve as we optimize landing zones, completion design, spacing, and lateral lengths over time. Underlying this very large wet gas play, we have a highly economic dry gas play. It lies predominantly in the Barnett and Woodford formations on the northern flank and represents at least 1,000 well locations, assuming 925-foot spacing. In this play, the BTU content is less than 10,050. The wells are characterized by low cost and high EURs. Many of the individual well flow rates have been very impressive. Again, we show a log-log rate versus cumulative production plot for the Alpine High dry gas wells. I've also added 3 hypothetical type curves with EURs of 10, 17, and 29 BCF. The performance of our wells group nicely around the 17 BCF type curve. This table contains the details for the dry gas wells plotted on the previous slide. As you can see, the dry gas window exists at depths of approximately 13,000 feet and deeper, as we would expect from our maturity model. The Barnett and Woodford exhibit excellent producibility, with an average 30-day peak IP of 14.6 million cubic feet of gas per day from only 4,650 feet of treated lateral. This is already a very predictable and repeatable play. The fully burdened dry gas economics are shown here, with a typical well having an EUR range between 17 and 23 BCF. Even though these wells do not contain liquids, they still generate very attractive economics due to high rates and a low cost structure. Again, the main takeaway here is the dry gas wells generate a net present value between $3 million and $7 million per well. Similarly, as we compare the Alpine High wet gas performance to the SCOOP/STACK, here we compare the dry gas performance at Alpine High to the Marcellus. Again, the Apache wells are the same dry gas wells previously shown, and the Marcellus dataset includes wells with first production date starting on January 1, 2014. The P50 type curves for the comparable dry gas Marcellus areas are compared to the actual performance from the Alpine High dry gas wells. You can see the Alpine High well performance tracks the upper end of the Marcellus type curves, again with shorter laterals and cheaper well costs. The Paris sequence interval comprises the Bone Springs and Wolfcamp formations and is present across the majority of the Alpine High play. As John showed in his geologic summary, the Paris sequences are much more complex, discontinuous, and contain many different rock types compared to the resource intervals in the Woodford, Barnett, and Penn. This interval is extremely thick and contains a very large array of landing targets. To date, we have drilled only 5 wells in the shallow oil play. However, every well we drilled to the source interval also passes through the Paris sequence formation. So far, that's 65 wells worth of data, allowing us to refine our mapping and improve our targeting of the Paris sequences, which in the long term will result in improved well performance. Although there remains much more work to fully understand this interval across our entire acreage position, we can safely say that we have at least 500 economic well locations at this time. Given the thickness, aerial extent, and number of potential targets, we are confident that our location count will increase over time. We have just scratched the surface in exploring this resource. We are excited about what we have learned and the tremendous upside potential this play holds. So let me walk you through our experience with testing the parasequence intervals. Our initial third Bone Springs test in the Mont Blanc No. 2 confirmed a black oil environment, which was consistent with our thermal maturity model and demonstrated attractive initial production rates, but fell off rather quickly from peak production. We drilled this well based on mudlog shows obtained through this interval from prior deeper wells. Our primary objective in the Mont Blanc 2H was simply to test oil productivity from the shallower horizons. Since that time, we have mapped a number of attractive potential landing zones across the area and have tested 4 additional completions. We drilled the Sycamore No. 401 along with 2 other wells to test different Wolfcamp target intervals. While we did produce oil in the 400-plus barrel per day range, we also produced a tremendous amount of water. This well was drilled near identified geologic complexities to test the limits of proximity to these features and their impact on well performance. Today, this well is still capable of producing at attractive oil rates. We would clearly have much higher productivity absent the water production. Part of our future delineation and development strategy will be to utilize our 3D interpretation to stay an appropriate distance from these geologic features to limit the likelihood of connection to the wellbores. The Cypress State 402 and 401 wells were the other Wolfcamp tests initiated about the same time as the Sycamore. These 2 wells tested separate landing zones within the Wolfcamp sequence. The Cypress 402 has been online for 134 days and has produced a cumulative production of 56,000 barrels of oil and 183 cubic feet of extremely rich gas. It's currently producing approximately 300 barrels of oil per day. Under our development scenario, wells like this will generate excellent economics with rates of return exceeding 100%. The Cypress 401 was completed later, and production is tracking performance of the 402. It is currently flowing at 700 barrels of oil per day and is still in early flowback, and we are continuing to evaluate its performance. What we know is that there is a considerable amount of oil in the Bone Springs and Wolfcamp intervals, and that our detailed geologic mapping and analysis should lead us to efficient, optimized development. Based on our well performance to date, and our understanding of the associated rock quality, we are confident in our 500-plus economic locations, which at this point is still limited to a relatively small area on the northern flank and crest. Now let's take a look at an example of future patterning and spacing development at Alpine High. This is an actual 3-pad unit that will soon commence batch drilling operations. It can take 6 to 9 months to drill, complete, flow back, and bring all of these wells on production. We've provided a gun barrel view of this half-section test in 3 Barnett zones and 3 Woodford zones. 12 wells are planned, implying 24 wells in the full section. Microseismic and pressure data from other spacing tests indicate that we can most likely drill wells with tighter spacing, which provides upside to our current 5,000-plus location count. To date, we have directed most of our delineation and testing activities into the northern flank, and therefore have a better understanding of how this area would likely look in development. Based on our confirmed landing zones, I am showing our most likely development scenario for a 640-acre unit in this area. In the source rock interval, we anticipate 2 landing zones in the Woodford, each with 660-foot spacing. 2 landing zones in the Barnett with 660-foot spacing, and 1 landing zone in the Penn, again with 660-foot spacing. This totals 30 potential locations per section in the source rock intervals. In addition, we have confirmed 2 landing zones in the parasequences, each with 800-foot spacing. This would add an additional 12 locations per section, bringing the total development to 42 potential well locations per section. Keep in mind we are currently conducting spacing and pattern tests and continue to test additional landing zones across our position. We have confirmed 10 landing zones which are present and prospective to varying degrees, so as we gather more data, these well counts could increase or decrease. However, based on what we have confirmed to date, this represents our most likely development scenario for the northern flank. We are pleased with the progress we are making on drilling, completion, and cost optimization. On the drilling side, there are a number of design optimization drivers that have led to improvements in rate of penetration, which include bit, bottom hole assembly, and drilling fluid optimization. In some areas, we have been able to eliminate the intermediate casing strings. There are also efficiency drivers leading to improved drilling economics. These include utilization of smaller, lower-cost rigs to drill surface and intermediate sections, pad and batch drilling operations, and longer laterals. As a result of these efforts, we recently drilled a pacesetter well with drilling and case costs of $1.9 million for a 5,050-foot lateral. We have also been able to drill and complete 3 wells with an average lateral length of 4,470 feet and an average cost of $5.5 million. In terms of completion optimization, we are in the very early stages and are testing multiple parameters. Based on this progress, we remain confident that in development, we will be able to achieve completed well costs in the range of $4 to $6 million. While we have seen some impressive results from our drilling program this past year, we have yet to drill our best well at Alpine High. Going forward, we will continue testing and progressing on many fronts. Across all areas of Alpine High, we will be conducting spacing and pattern tests, testing new landing zones, and optimizing lateral length and completion designs. In addition to these optimization initiatives, in the northern flank, we will accelerate testing of the Wolfcamp and the Bone Springs to further delineate the parasequence oil play. On the crest, our additional efforts will focus on testing for oil in the shallower source intervals and in the parasequences, as well as continued optimization in the drilling program to drive down costs. And in the southern flank, we will complete our delineation program and focus on testing for oil in the shallower source intervals and in the parasequences. It has been an exciting year. We have collected a tremendous amount of data and made significant progress toward a full field development plan for Alpine High. We have an in-depth understanding of the very large and highly economic wet gas play, which will continue to grow and scale. We have an equally good understanding of a highly economic dry gas play, focused mostly in the Woodford Formation in the northern flank, and we have initiated and integrated technical analysis calibrated to well control in an emerging oil play in the parasequences. There is still much more to come. With that, I'll now turn the presentation over to Steve.
Thank you, Tim. I'm going to review the basis for our infrastructure build-out at Alpine High and update the progress we have made to date. I will also provide a look into future processing and pipeline considerations, and I'll conclude with an update on our marketing efforts underway for Alpine High hydrocarbons. Alpine High infrastructure capacity and facility designs have always been dictated by the anticipated potential of the wet gas play. When we began design and construction, we were fortunate to have key personnel and organizational resources to draw upon. Much of that experience came from the build-out of similar facilities in the Permian Basin and in the western desert of Egypt. We began construction last November with plans to start up the first facility and to flow gas to sales by the end of June, an aggressive schedule. We actually flowed first gas to sales 2 months earlier on May 3rd. To achieve gas sales, we had to install 14 miles of 30-inch gas takeaway trunk line, a northern sales connection into the Comanche Trails pipeline, 4 miles of field gathering lines, and 5 production facilities. And we had to construct and commission our first central gas processing facility. This also required substantial support infrastructure in terms of roadways, electrical systems, and communications towers. There was a tremendous amount of activity required to deliver first Alpine High gas sales by May 3rd, and our teams did a great job. The backbone of Alpine High's infrastructure system is a gas trunk line being built through the play to flow processed gas from the field to the market. We will lay approximately 70 miles of 30-inch trunk line to move gas to sales connections in the north and in the south. Although it is a single line, it will flow gas to sales in both directions, so it is actually two export routes. Assuming compression to 1150 psi, these two export routes would have a combined capacity to flow 2 to 2.25 BCF a day of gas to market. The trunk line is being constructed in 5 segments, 2 of which are complete and operating today. Segment 5 is currently under construction. In total, we have installed 42 miles of this 30-inch trunk line to date. We made the first sales connection in the north earlier this year and have been flowing all sales gas through it since May 3rd. There are 3 sales connection opportunities to the north, and as of today, we have accessed 2 of those. There is 1 sales connection opportunity to the south, and it is scheduled for connection later this year. We are building processing capacity in the field mostly in 50 million cubic feet per day modular increments. We have also begun the process of going back to facilities and expanding them with an additional 50 million cubic feet per day of capacity. In terms of total gas processing capacity, we currently have 3 facilities operating with a gross inlet capacity of 200 million cubic feet per day. These are all refrigeration units and are recovering an average of 50 barrels of NGLs per million cubic feet, but range as high as 75 barrels of NGLs per million cubic feet. As we continue with our upstream development program, we will expand gas processing capacity as required through new installations and expansions at existing installations. As John mentioned previously, 2 of those new installations have been delayed slightly due to supply chain disruptions caused by Hurricane Harvey. By year-end, we should have 5 processing facilities operating with a gross inlet capacity of 330 million cubic feet per day. Cryogenic processing is definitely a possibility in lieu of continuing to expand refrigeration capacity, and is under active consideration at this time. Looking forward, we will continue building out capacity on an as-needed basis. Today we are trucking all oil and NGL production out of the field. We anticipate moving these to pipe transport in the 2019 to 2020 timeframe, and will update you as we move forward. Eventually, we anticipate the need for a 3rd gas export route from Alpine High. Current plans are to build that line directly to the Waha area in the 2020 to 2021 timeframe. By the end of 2018, we will have over $1 billion invested in infrastructure assets, and this will continue to grow for the next several years. As we have indicated all along, investing in these assets now is strategically important. We want to have complete control over access to processing and transport capacity, the pace and location of build-out, and the specification of facilities being constructed. There will come a day when full ownership and control are no longer required. We are building a very large infrastructure system that will make for an extremely attractive midstream enterprise, supported by the anticipated growth and quality of the Alpine High upstream. There has been a tremendous amount of interest from a wide variety of potential partners, and we are actively exploring the full range of monetization options. These range from retaining full ownership for the long term to a complete exit. However, we anticipate having some form of continued ownership in this enterprise for a long time. The key is that we have a lot of flexibility, both in terms of monetization structure and the timing of when that might occur. On marketing, I will not go into great detail due to the competitive sensitivities, but I will give a broad view of where we are today. On the gas side, we are currently moving all of our gas through the northern sales connection into the Comanche Trails pipeline. All of this gas is going to Mexico and is being priced at a slight premium to Waha daily basis. As we have indicated in the past, our desire is to contract a portfolio of transport and sales agreements to access multiple delivery locations and multiple pricing bases. We have made some progress on this front and continue to work many options. As you are all aware, there are multiple projects in competition for sanctioning to move gas to the Texas Gulf Coast, where demand is strong and growing. We are in conversations with multiple parties about these options. Our oil is currently being trucked from central tank batteries in the field. We are selling all of our oil in the field at Midland Daily Index pricing, less trucking costs of just under $3 per barrel. In the future, as we move these volumes to pipe transport, we anticipate our pricing basis will remain the same, but we will replace the trucking costs with pipeline transport at a significantly lower cost. Like oil, our NGLs are also currently being trucked from the field. We are selling all of our NGLs in the field at Mont Belvieu-based pricing, less trucking and typical transport and fractionation fees. We are typically realizing pricing at just over 60% of WTI before paying the local trucking costs. Again, as we move these volumes to pipeline transport, we anticipate significantly lower costs. I will now turn things back over to John.
Thank you, Steve. I'd like to close with a review of our production ramp at Alpine High and a look into our year-end production target there, followed by some concluding thoughts on our business overall. We have made remarkable progress in a little over a year since we announced Alpine High. Just 6 months after breaking ground on our gathering, compression, and processing infrastructure in November, we achieved first gas sales in early May. Recall that this was nearly 2 months ahead of schedule. We subsequently exceeded both our June production target of 50 million cubic feet per day and just recently our September target of 100 million cubic feet net to Apache. We are currently producing approximately 101 million cubic feet per day of gas, 1,425 barrels of oil, and 2,025 barrels per day of NGLs net to Apache from 34 producing wells. By year-end, we anticipate these volumes will grow to 125 million cubic feet per day of gas, 1,900 barrels of oil, and 3,000 barrels per day of NGLs net to Apache from 42 producing wells. This assumes that the startup of our Hidalgo Central Processing Facility occurs in December as expected and does not slip into next year. Notably, by May 2018, which will be our 1-year anniversary of first production at Alpine High, this play will have completely replaced the approximate 50,000 barrels of oil equivalent per day of production that we divested when we exited Canada this year. Importantly, the margins on our Alpine High production will be significantly higher than our margins in Canada. Before I close the presentation, I would note that we have several other plays in evaluation on our Alpine High acreage and elsewhere in Apache's portfolio. We continue to drill and test these ideas, and we will keep you informed of meaningful results as we have them. We understand the market's eagerness for more information, and we are just as eager to provide it. In some cases, our communication has been limited as the proliferation of new competitors creates certain disclosure considerations that were not applicable a year ago. What has not changed is our focus on maximizing value from Alpine High for our shareholders. As you can see, we have taken a very scientific approach, building on the data we collect and prudently transitioning to development as efficiently and safely as we can. In the Permian Basin, outside of Alpine High, we are very pleased with our recent pad development performance and production growth trends, particularly on the oil side where we are tracking at the high end of the Midland Delaware oil guidance we provided back in February. Internationally, we are benefiting from the recent relative strength in Brent crude prices and are excited about our drilling opportunities going into 2018. We are currently working on our 2018 budget and will come back to the market with an updated view once completed and approved. If we decided to base the updated budget on a more conservative price deck than assumed in our current guidance, then you can expect us to revise our capital program and other assumptions accordingly. Overall, despite some Harvey-related delays, we are very pleased with our performance at Alpine High and in the rest of our operations. Our international operations continue to generate strong free cash flow, and across the company, Apache has intensified its commitment to generating long-term, full-cycle, fully burdened rates of return.